State Farm just pulled out of California. Allstate abandoned Florida. Farmers Insurance walked away from entire counties in both states. Combined, that's over $200 billion in coverage capacity that simply vanished in 18 months. The media called it climate risk, policy adjustments, market dynamics, but there's something they're not telling you, something that connects these seemingly random withdrawals to a much larger pattern. Because this isn't just about hurricanes and wildfires. This is about interest rates, commercial real estate, and a financial mechanism that is about to destroy the middle-class safety net millions of Americans depend on. The real threat isn't the storms everyone can see. It's the silent financial crisis brewing inside every insurance company, pension fund, and bank that thought they understood risk. Here's what you need to know. When insurance companies start abandoning profitable markets, they're not running from weather. They're running from mathematics. And the mathematics say something catastrophic is coming. By the end of this video, you'll understand the 4-stage insurance collapse pattern that has repeated itself 3 times in modern history. You'll see why Lloyd's of London nearly disappeared in the 1990s, how AIG's 2008 crisis was just a preview of today's threat, and why Japanese life insurance companies went extinct despite having centuries of stability. You'll learn why rising interest rates destroy insurance balance sheets faster than any natural disaster, and why commercial real estate exposure makes the current crisis mathematically unsolvable. Most importantly, you'll understand why your homeowner's policy, your pension, and your retirement account are all connected to a 900 billion time bomb that's already started counting down. This isn't about individual company failures. This is system design revealing its fatal flaw. Every insurance crisis follows the same 4-stage pattern. Different triggers, different countries, but identical progression towards systemic failure. Stage 1, silent erosion. Insurance companies appear healthy on the surface. Premiums get collected, claims get paid. Regulatory reports look stable, but underneath, the balance sheet is deteriorating. Asset values decline while liability costs increase. The gap widens slowly at first, then faster. Management delays recognition, hoping conditions improve. They don't. Stage 2, selective withdrawal. Companies start abandoning markets that look risky, but the real reason isn't what they claim. They're not fleeing hurricane zones because of weather. They're fleeing because their investment portfolios can't generate returns high enough to cover claims, plus maintain required capital reserves. The withdrawals accelerate as more companies recognize the mathematical impossibility of maintaining coverage at current premium levels. Stage 3, cascading failure. Individual company failures trigger contagion across the sector. Reinsurance costs spike as remaining capacity shrinks. Premium increases can't keep pace with rising claims costs, plus investment portfolio losses. Pension funds and banks holding insurance company bonds face massive write-downs. The interconnectedness becomes visible only when it's too late to prevent systemic damage. Stage 4, system collapse. Government intervention attempts to prevent total breakdown, but the scale overwhelms regulatory capacity. Policyholders discover their coverage is worthless. Pension funds holding insurance investments face insolvency. The safety net that millions depended on simply ceases to exist. This isn't speculation, this isn't fear-mongering, this is documented historical pattern. And we're currently deep in Stage 2, accelerating towards Stage 3. Let me prove this pattern with 3 undeniable examples, starting with the most devastating. Lloyd's of London, 1990s. Lloyd's wasn't just any insurance market. For over 300 years, it had been the backbone of global marine insurance, covering everything from ships to satellites. Lloyd's members, called names, provided personal guarantees for policies. Rich individuals pledged their entire estates as collateral. The system seemed unbreakable because it was backed by generational British wealth. Stage 1 began in the 1980s. Asbestos claims started mounting in America. Lloyd's had insured factories, shipyards, and construction companies for decades without fully understanding the liability they'd assumed. Each asbestos case could generate millions in claims, and there were thousands of cases. Simultaneously, their investment returns began declining as British interest rates fell and property markets stagnated. But Lloyd's management assured names that the American legal system would limit payouts. They convinced members to increase their exposure, bringing in middle-class doctors, lawyers, and professionals who pledged homes and life savings. By 1990, over 34,000 names backed $11 billion in policies. Stage 2 hit hard. As claims exploded and investment returns collapsed, Lloyd's started selective withdrawal from high-risk markets. But instead of admitting the mathematical problem, they blamed external factors. Greedy American lawyers, unpredictable natural disasters, regulatory changes. Meanwhile, they recruited new names to replace capital being consumed by losses. This is classic insurance crisis behavior. When the balance sheet breaks, management focuses on blame assignment rather than risk reduction. Stage 3 cascaded through the 1990s. Individual names started facing bankruptcy as claims exceeded their personal wealth. In 1992 alone, Lloyd's reported $2.9 billion in losses. By 1995, cumulative losses reached $8 billion. Names who had pledged everything, lost homes, businesses, entire family fortunes built over generations. The suicide rate among Lloyd's names increased dramatically. Families who had been wealthy for centuries were financially destroyed. The British government eventually intervened, but only after thousands of middle-class investors had been wiped out completely. Stage 4 concluded with fundamental restructuring. Lloyd's abandoned the unlimited liability system that had worked for 3 centuries. Corporate capital replaced individual names. The old Lloyd's effectively ceased to exist, replaced by a completely different entity using the same name. Total wealth destruction. Over $15 billion in individual losses, plus systemic damage to British insurance capacity that took decades to rebuild. AIG to date. American International Group was the world's largest insurance company, with operations in 130 countries and $1 trillion in assets. AIG seemed diversified, stable, too big to fail. They weren't just writing property insurance. They were writing credit default swaps on mortgage securities, essentially insuring Wall Street's riskiest bets. Stage 1 developed through the mid-2000s. AIG's investment portfolio was loaded with mortgage-backed securities and real estate assets. As housing prices peaked and interest rates remained low, their investment returns looked strong. But they were also writing massive amounts of credit protection on securities they didn't fully understand. The revenue looked good. The risks were hidden in complex derivative structures. Stage 2 hit in 2007 as housing markets started declining. AIG faced margin calls on their credit default swaps as the underlying mortgage securities lost value. Their real estate investment portfolio simultaneously declined. But they were contractually obligated to post additional collateral as losses mounted. This created a liquidity death spiral. The worse their investments performed, the more cash they needed to post as collateral. Here's the invisible mechanism that destroyed them. AIG's insurance operations were profitable and stable, but their derivatives business required cash collateral that exceeded their available liquidity. They couldn't sell assets fast enough to meet margin calls without triggering fire sale prices that made the problem worse. Stage 3 accelerated in September 2008. Within days, AIG needed $85 billion in emergency funding just to avoid immediate bankruptcy. The Federal Reserve had to intervene because AIG's failure would have triggered counterparty failures across the global financial system. Major banks holding AIG policies and derivatives would have faced immediate insolvency. Stage 4 required unprecedented government intervention. The Federal Reserve eventually committed $182 billion to prevent AIG's collapse. But the old AIG was effectively dismantled, sold off in pieces, and fundamentally restructured. Japanese life insurance, 1990s, 2000s. Japan's life insurance industry seemed unshakable. Companies like Nippon Life and Dai-ichi Life had operated for over a century. They offered guaranteed returns to policyholders, typically 4 to 6% annually, which seemed modest and sustainable. Stage 1 emerged as Japan's asset bubble collapsed in the early 1990s. Life insurance companies had invested heavily in Japanese stocks and real estate during the 1980s boom. When those assets lost 60-70% of their value, the companies faced massive portfolio losses, but they still owed policyholders guaranteed returns on trillions of yen in coverage. 7 major life insurance companies failed between 1997 and 2001. Nissan Mutual Life, Daihaku Mutual Life, Taiyo Life, Tokyo Life, Chiyoda Mutual Life, Kyoei Life, and Tokyo Mutual Life all collapsed despite decades of stability. Combined assets under management exceeded Weimaraner's $15 trillion. The wealth destruction was generational. Japanese households had relied on life insurance as their primary savings vehicle for retirement. When the companies failed, entire family financial plans collapsed. The social trust and insurance that had been built over centuries was permanently damaged. 3 examples, 3 different decades, 3 different countries. Same pattern, same stages, same devastating outcome. And today's American insurance crisis is following this script exactly. The signals are everywhere if you know what to look for. And they're accelerating faster than any historical precedent. Interest rate environment is crushing insurance investment returns. Insurance companies invest premium collections in bonds and fixed income securities to generate returns that cover future claims, plus profit margins. When 10-year Treasury yields were 6 and 7% historically, this model worked perfectly. At 4.5% current yields, and with claims costs rising 8 to 10% annually, the mathematics break down completely. State Farm reported $13 billion in underwriting losses in 2022 alone. Not weather-related claims losses. Underwriting losses, meaning their premium collections couldn't even cover their operating expenses before any claims got paid. They're operating at a structural deficit that can't be fixed by raising premiums alone. Commercial real estate exposure creates the second crisis layer. Insurance companies hold approximately $650 billion in commercial real estate investments and mortgages. Office buildings, shopping centers, hotels, apartment complexes. As work from home reduces office demand and rising interest rates pressure property values, these investments are declining rapidly while remaining illiquid. Here's the mechanism most people miss. Insurance companies can't sell CRE assets quickly without triggering fire sale prices that force them to recognize massive losses on their balance sheets. But they also can't hold assets that are declining in value while their claim liabilities increase. They're trapped in a classic liquidity squeeze. Climate claims are accelerating beyond any historical model. Hurricane Ian alone generated $63 billion in insured losses in 2022. But Ian was not unusually large or powerful. The damage came from development patterns that put expensive properties in high-risk areas, combined with inflation that made rebuilding costs 40-50% higher than previous estimates. California wildfire risk now affects property values across the entire state, not just traditional high-risk areas. Florida hurricane exposure has expanded inland as storm surge modeling reveals broader flood zones. Texas faces increasing hail and wind damage as climate patterns shift. The risk isn't just increasing, it's expanding geographically beyond traditional pricing models. Reinsurance costs tell the real story. Reinsurance is insurance for insurance companies. When primary insurers can't handle large losses alone, they buy protection from reinsurance companies. Global reinsurance rates increased 50-75% in 2023 alone. Some markets saw 200-300% increases. Property catastrophe rates in Florida and California became unaffordable for many companies. When reinsurance becomes unaffordable, insurance companies must either stop writing policies or self-insure for catastrophic losses. Most companies don't have capital reserves large enough to self-insure against major hurricanes or wildfire events, so they withdraw from markets entirely. Pension fund interconnectedness creates systemic contagion risk. State and local government pension systems hold approximately $200 billion in insurance company investments. Corporate pension plans hold another $150 billion. When insurance companies face financial stress, pension funds holding their bonds and equity investments face immediate losses. CalPERS, the California Public Employee Pension System, holds major positions in several insurance companies currently facing Florida and California market withdrawals. If those companies fail, CalPERS faces losses that must be covered by California taxpayers or benefit reductions for retirees. This isn't theoretical. Connecticut's pension system lost $2.8 billion in 2008, largely through AIG exposure. When insurance companies fail, the damage spreads immediately to pension systems serving millions of public employees and retirees. Regulatory forbearance is creating false stability. State insurance commissioners have discretionary power to allow companies to delay recognition of investment losses under certain circumstances. They can permit companies to carry bonds at historical cost rather than market value. They can extend deadlines for capital adequacy requirements. This regulatory flexibility prevented immediate failures during 2022-2023 interest rate spikes. But it also masks the true scale of balance sheet deterioration across the industry. Companies that appear adequately capitalized under regulatory accounting might be functionally insolvent under market value accounting. Rating agency downgrades reveal the underlying stress. Moody's downgraded 17 insurance companies in 2023, more than the previous 3 years combined. AM. Best revised outlooks to negative for 23% of companies under review. These aren't random events. They're systematic recognition that current business models can't generate adequate returns under current conditions. Here's the pattern that should terrify you. Every signal that preceded Lloyd's, AIG, and Japanese life insurance failures is present in today's American insurance sector. Interest rate pressure, investment portfolio losses, regulatory forbearance, selective market withdrawal, increasing reinsurance costs, pension fund interconnectedness. We're not approaching stage 3. We're already in it. When the insurance system breaks, it doesn't break cleanly. It breaks chaotically, destroying wealth and security in ways most people never anticipated. Your homeowner's policy becomes worthless, not because the insurance company refuses to pay claims, but because the company simply ceases to exist. Policyholders become unsecured creditors in bankruptcy proceedings. Claims get paid at cents on the dollar, years after the damage occurred, if at all. This isn't theoretical. When Reciprocal of America failed in 2003, policyholders received approximately 30 cents per dollar of coverage. Property owners who lost homes to hurricanes faced years of litigation just to recover partial payments. Many never rebuilt. Some faced foreclosure because mortgage companies required insurance that was no longer available. Your pension disappears in stages. First, pension funds holding insurance company investments face immediate losses as those investments lose value. Then, the pension fund must reduce benefits or increase contributions to maintain actuarial balance. Finally, if enough insurance companies fail simultaneously, pension systems face insolvency and require taxpayer bailouts or benefit cuts. Illinois state pensions lost $8.4 billion through insurance company failures and downgrades between 2008 and 2012. Those losses translated directly to higher taxes for Illinois residents and reduced benefits for retirees. The connection between insurance failures and pension losses is invisible until after the damage occurs. The regional economic impact cascades rapidly. When insurance companies abandon markets like Florida and California, property values decline immediately. Homes become unmarketable without insurance availability. Mortgage lenders retreat from uninsurable areas. Local tax bases shrink as property values fall. Commercial development stops in uninsurable areas. New construction requires insurance availability. Existing businesses struggle to renew coverage. Economic activity shifts away from high-risk regions, creating regional depression in previously prosperous areas. This is already happening in parts of Florida and California where insurance availability has disappeared. Property values have declined 15 to 20% in some coastal areas, not because of storm damage, but because of insurance unavailability. The economic damage precedes any actual catastrophic events. Here's what makes this particularly devastating. The insurance crisis hits middle-class wealth specifically and disproportionately. Wealthy individuals can self-insure or relocate assets. They have alternative risk management strategies. The poor have little to lose, but middle-class families depend entirely on insurance systems that are breaking down. A middle-class family with $300,000 in home equity, $200,000 in retirement accounts, and a pension plan faces potential loss across all categories simultaneously. Home equity disappears if insurance becomes unavailable. Retirement accounts lose value through insurance company investments. Pension plans face cuts due to insurance-related losses. The wealth destruction is systemic and permanent. Unlike stock market crashes that eventually recover, insurance system failure creates permanent loss because the protective infrastructure itself gets destroyed. You can't rebuild decades of actuarial data, risk assessment capability, and capital reserves quickly. The industry capacity takes years or decades to reconstruct. 5 indicators tell you exactly where we are in this crisis and what comes next. Reinsurance renewal rates in June and December each year reveal sector stress levels. Increases above 25% indicate systemic pressure. Increases above 50% indicate crisis conditions. Current rates in catastrophe-exposed markets are running 75, 150% above 2022 levels. State insurance commissioner emergency orders show which markets are breaking first. Emergency rate approvals, market withdrawal notifications, and regulatory forbearance declarations increase rapidly before systemic failure. Florida and California commissioners issued more emergency orders in 2023 than the previous 5 years combined. Credit rating agency, negative outlooks and downgrades accelerate 12 to 18 months before company failures. When 20% or more of companies in a sector face negative outlooks simultaneously, systemic crisis becomes mathematically unavoidable. We're currently at 23% negative outlooks across property casualty insurers. Pension fund insurance investment performance reveals interconnected damage. When pension funds report losses exceeding 5% annually from insurance holdings, the contagion risk becomes significant. Several major public pension systems reported insurance-related losses exceeding 8% in 2023. 10-year Treasury yield inversions, with insurance company bond yields show when the sector becomes uninvestable. When companies must pay higher rates than government bonds to raise capital, their business models break down permanently. This spread has widened to historically dangerous levels across multiple insurance sectors. This isn't about timing a crash. This isn't about getting rich from crisis. This is about recognizing when your safety net is dissolving before you need it. Next episode, we examine the pension crisis that makes insurance failures look like a warm-up act. How $38 trillion in unfunded liabilities becomes the final mechanism that transfers middle-class wealth to institutional creditors. Because when both insurance and pensions fail simultaneously, the last protection disappears entirely. The pattern is mathematical. The timeline is accelerating. Systems don't break suddenly, they break predictably, then all at once. Understanding what's coming isn't pessimism, it's pattern recognition that gives you time to act before the safety net disappears completely.